Okay, it's November 10th, 2017. It's Friday, and we're trading through the London into the early New York session. This is a trade we just closed, and I made an update video yesterday, and I was talking about the size of the stop loss. So very often for new subscribers, I get the question, what size stop loss do you use? And you've probably heard me say this in previous videos, but it's worth repeating as often as possible when somebody has this question, because that's one of the most important things is a stop loss placement. You know, how large is that stop loss placement? What is the trader who's executing these trades? What are they doing? You know, these are some of the thoughts that a lot of subscribers go through and are wondering prior to signing up. So I never use a stop loss larger than 55 pips, but it doesn't mean that every trade that I take will require a 55 pip stop loss. So I have different techniques. For example, the HL30, you've probably seen me talk about that here in the on the website in videos somewhere, or in the YouTube channel, things like that, or the update videos that I send out through email. And the HL30 is a short-term reversal technique, and it only requires a 20 pip stop and a 20 pip target. And very often, if price continues in the trending direction after it hits the first target, very often we can trade it to a second target for an additional 20 pips. Now I talk about how to earn up to 60 pips when you trade the HL30, but I'm not going to talk about that today. What I really want to focus about or focus on is about the stop loss placement. So again, when I say that I never use a stop loss larger than 55 pips. Again, it doesn't mean that every trade that I execute will require a 55 pip stop loss. And I'm going to show you exactly what we did here with the HL30. We just closed this trade just a few hours ago. And now there is a continuation breakout trade. That's a different technique. That's not the HL30. It's a different technique. I use that on the 1 hour time frame. And that's trading a breakout of consolidation and then the trending move that develops afterwards. So with that technique, the continuation breakout trade, that's the one that I use a 55 pip stop loss on. But it's never larger than a 55 pip stop loss. And very often, even when I execute the continuation breakout trade, I'm not going to talk about that today. Right now, we're going to talk about the HL30. But when I execute the continuation breakout trade, even though I'm prepared to use a 55 pip stop loss, if I can see that the trade isn't going to work, then I can close the trade and minimize the loss, the stop loss. So I don't even if a continuation breakout trade fails, I'm not going to experience a 55 pip stop loss or a loss on that trade. It's probably going to be maybe 35 pips max. Usually I can tell if a trade isn't going to work, and I'll close the trade down maybe minus 27, 28 pips, something like that, 31 pips. But it doesn't mean we're going to experience a 55 pip stop loss, take that kind of a hit on a losing trade. I haven't had a stop loss or a losing trade that was 55 pips in a long time. I mean, we just don't use it. There's really, in most cases, no reason for it. The only time something like that might happen is, let's say the news, is released after we're already into the trade, and it's just a wild, quick, blink of an eye kind of movement. Then it might trigger a stop loss that would be 55 pips, where nobody could, get out of the way in a situation like that. But that doesn't happen all that often. So with the HL30, this is the euro dollar, and I use the HL30 on the 30-minute time frame. So what, again, and I talked about this just a few days ago, this is the same technique that I used with non-farm payrolls last week. Obviously, this is not non-farm payrolls, and the reaction is a little bit different, but you can see the behavior. The spike, you can see that video on the performance page with non-farm payrolls. It was a spike after non-farm payrolls that created the 10 pip range. But here, what we're doing is, this is Thursday's trading range right here. And we had the low, or I'm sorry, the open, and here's the low, and then we had the close of the day at the 5 p.m. rollover, and here's the high. So we identify the high and the low of the previous day when the rollover period occurs. So the high yesterday for Thursday was 54. Let's see if I can get that in there. The high was 1.1654. So this is our red line right there. That indicates resistance, right? So now price needs to go up to at least that 10 pip range. So if the high was 54, price needs to go up to at least 44 to qualify. And here, just a couple of hours later, maybe an hour or so later, after the rollover period, it reached that 45, but it kept going. Once it reaches the 10 pip range, we still need the reversal candle, that whether it's an engulfing candle, and I have them all listed out in the manual for the HL30. you can see exactly what it takes to signal a reversal candle. It could be an evening star, morning star, depending on if you're trading off of support or resistance, an engulfing candle pattern, something like that. So what we're doing here is waiting not only for the 10 pip range, which means price needs to go up into that range, but then we still have to wait for the reversal candle. And then once we get the reversal candle, then we have to confirm with the CCI. So the CCI reading on the close completed reversal candle, once we get that, has to be printing a lower reading than the previous day's high CCI reading. This one printed a lower reading. Not by much, but it did print a lower reading than the previous day's high CCI reading. So that was our entry at 47. Now, again, I mentioned with the HL30, it only requires a 20 pip stop loss. So if we're getting in at 47, then 67 is the stop loss back up here. We use a 20 pip stop, 20 pip target. That means that a 20 pip target getting in at 47, our take profits at 27. So you can see how this one's very different than non-farm payrolls. Non-farm payrolls, again, that spike after non-farm payrolls, the news, caused price to move up into the 10 pip range area to give us step one of the development of the HL30. That's step one, is it has to go into the 10 pip range. Step two, we have to wait for the reversal signal candle, and that's what we got here. We had to wait for that non-farm payrolls. I think it was like 2 hours afterwards. In this instance, it wasn't related to the news. It's just, again, we're trading off of the previous day's high and low, and it's a short-term reversal, meaning that we can't expect price, in most cases, to come all the way back down here, take out support, and develop a brand new trend. This is a short-term trade. We're trading inside the previous day's trading range. So you have to get your expectations in line. You have to be, in order. Things you have when you get into the trade. So that's very often one of the challenges that a lot of new traders experience. I went through this. When I got into the trade, I didn't know how long to hold on to the trade. I didn't know how many hours. I didn't know how many pips. I didn't know what to look for as a target. I wasn't really paying attention to the previous day's trading range, even though it was obvious right in front of me. In the beginning, when you first start trading, you don't have the ability to absorb all of this information. You have to continue to expose yourself to it. So again, it's easy by working off this checklist. Now, by the way, I executed this trade with the trade copier. So the trade copier got this trade. I mean, it worked just exactly as I'm showing you. So it takes sometimes a few hours. Sometimes it'll take a few hours for price to reach that target. Sometimes, it'll take just a couple of hours, and then maybe some news or a comment will push price right down to that target. Now, I mentioned that you could potentially get 60 pips out of this trade. And how that works is after price hits the first target, we would then try to trade it to another second target of 20 pips further. That's 10 pips. That's 20 pips right here from that first target. So if price continued down and tested support from the previous day, it could potentially pay another 20 pips. You still have to lock in the profits here at the first one. So the way I recommend executing this is putting on 2 lots on the trade when you open the trade, closing the first lot here at the first target, and then setting the second lot at a break-even stop so that if it does continue to the second target, effectively you're earning 60 pips because from the second lot, you're going from 47 to 0.7, that's 40 pips. On the first lot, you're going from 47 to 27, that's 20 pips. And this is approximations. This is not obviously taken into consideration the pip spread. Everybody's using a different broker, so it's not possible for me to calculate exactly what it would be for everyone. But you get the idea. We have to trade what we see here in the charts, not what we see on our trading platform. If it just happens that you get in at 47 at the right location and you take profits at 27 and you only end up with 18 pips, then that's, between you and your broker and the spread that you're paying as a result of, for taking that trade. You're going to have to work with a broker that's got a much tighter spread, especially at certain times of the day. That's another thing to take into consideration because sometimes after the rollover, the pip spread can be a little bit wider as well with some brokers. It just depends. You have to find a broker that's going to give you the best rate, the best price, the best pip spread. So that's going to help you improve your performance. So again, the only thing we can do is trade what we see here in the charts. The close of the signal candle, the actual distance from the, where you're supposed to get in, the pip spread, again, that's totally something separate for each individual trader because they're using a different broker and paying different amounts. So it's always going to be approximate, but it's always going to be 20 pips from that target. You've got to lock in profits here at that target, 20 pips from the entry, I'm sorry. So you have to lock in profits at the first target appropriately, and then if price continues, and very often it does, it just doesn't do it all the time. In this case, it didn't. It went down and hit that take profit, the first take profit level, And that was it. That's all we got. We earned approximately 20 pips, and then the whole thing turned around and went right back up. And now it's about to start pulling back down again here on the next live candle there. So every day is just a little bit different. And this trade is, you know, I'll execute this on any of the majors: the euro dollar, pound dollar, dollar Swiss, dollar yen. Now there are times when the HL30 might not work, so I have strategies and trading manuals in the modules, the HL30 modules, that will show you how to identify when a HL30 could potentially fail. Because you'll notice that I did not execute the HL30 on all of the currency pairs today. Some of them didn't look like they were going to work, and it really depends on the previous the trading environment prior to getting that actual signal candle. So this is how it works. So the HL30 is a technique that I used here. This is the last one the last trade that I closed here. I don't know if we're going to get any other trades before the the market close Friday for the New York session, but I'll always be looking and for more opportunities. But this is exactly what the trade copier does. It opens up the trade right at that specific location when I execute the trade on my platform, and then I set the take profit and the stop loss, and it just, we just leave the trade alone. I mean, we have to let it do its thing, and they're very simple trades. Again, we're not expecting a whole lot, but it'll give you an idea, first of all, of how long some of these trades can take before they reach their targets, and what size stop loss. That's really what I really want to talk about in this particular video, is to get you prepared for the fact that if you're going to use the trade copier, you want to be aware of the kind of stop loss, the size of the stop loss that I'm using. And it really depends on the kind of, or the technique, the actual strategy, the environment, the tool. So I look at these different trading techniques as different tools, depending on how the market's behaving, what I need to do, whether there's consolidation, whether it's a trending environment, all of that. And that determines which trade technique I execute. And again, there's different stop losses for each technique, but never, ever exceeding more than 55 pips. But it doesn't mean that when I experience a loss, it's going to be 55 pips. I can always control that and minimize it anyway. Thanks for watching.